All right, welcome in. Good evening, traders. It is Tuesday, October 22, 2024. Good day for the portfolios today in the markets. Love what happened. We made some more money. Good realized gains today. Some pretty big wins for us. So I'm going to cover a little bit of that. Sorry, I got a little bit of a cold today. But before we really get into the accounts and what we're trading and we're doing, I want to spend a few minutes and just talk about diversification. So is diversification really necessary, especially when you're trading the S&P 500 like we are? So primarily, almost everything we're doing is based on the S&P 500. So we're pretty well diversified to begin with. That's 500 of the largest publicly traded companies in the U.S. We have a bunch of different industries, a bunch of different sectors. We got technology, we got healthcare, we got financials, we got consumer goods. It's a pretty broad representation of the entire economy. And it's got built-in diversification, I believe, across multiple sectors. Now, it is heavy weighted. So you've got, Apple and the Microsoft and Amazon's and those big, large cap companies. They're going to have a more significant impact on the S&P, of course. But long-term, the S&P has continued to grind higher. And when we listen to great traders like Warren Buffett, he famously stated that diversification is not really necessary for those who know what they're doing. Up until a little months ago, he had 50% of his entire company in Apple. He has a large stake in many companies. So he doesn't have a ton of companies. He's got good quality companies. Well, the S&P 500 is similar to that. And diversification, as according to Buffett, is really a protection against ignorance. So you don't need to have 100 stocks or 140 stocks. Okay? Understand a few good companies that have great cash flow, that have great balance sheets, little to no debt. Okay, just again, cash cows, tons of cash, buy back their shares, reduce their float, maybe even pay a dividend. I don't care much about the dividend as much as I care about, are they reinvesting in R&D? I would rather companies not pay dividends and put that money back into R&D and make their company better. Now, I get it, the dividend puts you in a different class. It can put you in other mutual funds as a dividend aristocrat, or at least a dividend paying company. So that's why you start to see, the Apples and the Microsofts of the world paying a dividend, whether it's small or not, doesn't really matter, because just by paying it, they get to put themselves into more potential mutual funds, get more ownership of the stock. However, I don't really think it's important. But for the average investor, invest in low-cost index funds like the S&P 500, like the QQQs. So SPY, QQQ, IWM for the small caps. That's really all you need to trade. And primarily, I would say 90% of what I'm trading is one of those. Now, I'm also trading futures, but it's on the S&P 500. I do have some diversification in some commodities like oil, and I also have bonds. Bonds aren't doing great right now, but it does give me some diversification. So we've got plenty of bonds. We've got plenty of the S&P 500. That's what we're doing. So we feel pretty diversified. And even guys like John Bogle and Ray Dalio and Peter Lynch all espouse that you could potentially just trade the S&P 500 because they want you to have a diversification, even though maybe the S&P is even too broad for some of them. Okay, but is there enough diversification in the S&P 500? Well, it's got global representation. So we've got companies, in the S&P that are multinationals. They've got significant revenue from outside the United States. So we've got exposure to global markets. Okay. We've got multiple sectors, as I talked about. We've got large cap stability because the large caps really run the S&P 500. The biggest limitations or concerns we have is we're concentrated in large tech, a lot of it, the Apple, the Microsoft, the Googles, the NVIDIAs, and so forth of the world. Okay. And then maybe we don't have a lot of small cap exposure, but that's what the IWM is for, and we can trade the small caps from there. So because of this, a couple of things that we've got to make sure that we pay attention to is I think we have enough diversification. We don't need to add a ton of other sectors. And even talking to some of our members and other traders out there, and they were even asking, should we even be in gold or oil or copper futures or the Aussie dollar strangles and all? The answer is no. You really don't need to. I feel I like a little diversification in those. We've got the election coming up. Volatility's increased. Is the election going to cause potentially some excitement the day after? Depending on who wins, somebody's going to be unhappy. It may not even be decided within the first 24 hours after the election. Not necessarily because it's that close, although it may be very close, and it looks like it's pretty close right now. If you believe some of the polls, I don't really believe most of the polls I hear. Okay? I don't really trust the national news media. I don't believe they're probably reporting a whole lot of things accurately. And I don't really believe that the polls are accurate. I don't think that certain people will even respond to polls or even want to tell you who they're voting for. So we'll see what happens. I'm not making any political statements at all. We'll see who wins, and then we'll see who complains, and then we'll see, is there any kind of major events or something that could potentially happen after that. We'll see. However, for me, the S&P 500 is the GOAT. It is where we want to be investing and where we want to be trading. I choose to do it through ES futures contracts. Why? Well, because unless you've got a large portfolio margin account, which I do have as well, okay, for my investments, okay, which is perfect. If you've got portfolio margin, you should be putting into, safer, larger companies. But I still think you could just trade the S&P 500 either through SPY or VOO. You could be using IWM. You could be using the Qs, QQQ. Okay, you could be trading there. If you want to dabble in some, individuals like the great companies like the Apples, Nvidias, Googles, Amazons, JP Morgans of the world, feel free to do that. Put a little bit in bonds, your TLTs or TMFs, and so forth out there to create a little diversification. But I think that's all you really need, okay, if you're trading with that portfolio margin. But not everybody has a portfolio margin account, and not everybody wants to trade and make just 1 or 2% a month. The S&P averages about 10% a year annually. If that's not good enough for you, and it's not for me, okay, then we got to juice it up with a little something. So we have a discretionary account or our trading account. Okay, so you got your investing accounts, big portfolio margin accounts. You also have your IRAs, maybe in some safer things, although we still do some futures in my IRAs as well. Okay, just not to the extent we do in a trading account. But in the trading account, that's our money where we want to get more than just being average. Okay, I don't want to just be average. I don't want to just generate 10% a year and go away and throw it into a mutual fund somewhere. You know what? If the market does drop a couple years in a row, I don't want to be watching it go down either. There's people that had their money in the S&P and then it dropped 30% or something here, or 20%, and they're watching savings go down. Okay, I'm not advocating that you should be all in, your trading account. Certainly not. Okay, all of your money should not be in a trading account, but a portion, I believe, should be. Maybe it's 75-25, maybe it's 70-30, maybe it's 80-20, maybe it's 50-50, 60-40, whatever you want to do. Okay, whatever your risk tolerance allows. And again, pardon my voice today, but I think you can survive just trading the S&P 500 instruments. That's primarily what we do in the Income Navigator service too. We're trading either SPY, SPX, or we're trading ES, maybe even MES for some smaller accounts. That's the majority of everything that we're trading in there. Okay? That's what we're trading. If I'm looking right now at my allocation, let's take a quick look. My allocation, ES is a little lower, but I'm letting it come off. We had some wins today, so we closed some off, some there. So we're down a bit on our ES. Let's take a quick look at what happened today. So here's the account. Yesterday, good day as well. So yesterday we had a naked put come off for $2,600. We also had an oil naked put come off for $5,600. We did roll a bond trade. So when we roll, I booked the loss on the current one, and then we set up the new trade with the credit. So we did roll for a credit, but as opposed to everyone telling you, hey, I took a credit on the roll. No, you took a loss on the roll. We'll wait to see what happens to the other one. It might be a winner where overall we're going to win. But I always booked the loss first on the part that we closed, and then we've got the new trade. Technically, I did roll for a credit, but I'm going to book the loss on the original. Okay, I'm not booking it as a credit, and I'm not going to tell you that, oh, we made $15,000 this week on, yeah, because you rolled. Essentially, what you did was you booked, $14,000 in losses, but you rolled out and took in 15 grand, which may or may not come to fruition. There, you're just not disclosing your losses. I've given you all of my losses. We had some horrendous losses in August on that Volmageddon day. Okay, we've recovered a good chunk of that. We're down 15% because of that, but that's not bad. Okay, I don't know that we'll get back to even by the end of the year, but we're making a great run at it. I also closed a naked put of a calendar 112 that we did for 4,700 today, and we also closed our 120-day naked puts for $1,400 today. So we've done pretty well today, closing some trades. And over in the Lazy Trader account, I did close a 1 DTE QQQ naked put. So that closed as well today. And then we added some spec trades. But what I'm doing to kind of prepare for the election, because again, I'm a little bit maybe concerned about what could happen at the election. Okay. Hopefully everything goes great. Everybody gets who they want. Half of you are going to be mad. Half of you are going to be happy. All I care about is, does the stock market go up? And will the policies help me continue to be able to take care of my family, trade for a living, and make great money out here and help as many people as possible? Excuse me. So what are we doing? So we had some trades come off in the last couple of days, all great winning trades. I mean, we're dialing in. I think for the month, we're up $17,000 right now. Okay, so this is one of the larger months that we've had. This is the 1, 2, 3, 4, fifth largest month of the year so far out of 10. Okay, so this is our fifth best month of trading ever and this year. Okay, so we're having a fantastic month, up over $17,000 in just the trading account alone. That is not counting the Lazy Trader account, which is also up about $8,000 this month, but we're not going to count that because that's not the goal there. But we booked 17 grand. And what I'm not doing is I'm not sticking a bunch of new trades back on. I want to wait till the election. We're down to 2 weeks. I don't think there's a reason. Now, yesterday we did enter a new calendarized 112. So we did enter a new 112 trade yesterday. We went 45 DTE on the naked puts. That does obviously put us past the election, puts us into December, which is a new futures contract anyway. So I'm okay with that. This is the least amount on purpose. So I have a full slate of trades, but it's the least amount of really Vega risk that I've had on. We've got a few hedges, not a ton. We've got our standard hedges, our vol hedges, our delta hedges, but really what we've done, and if you looked at the Lazy Trade or the trade tracker here, we are at 45% buying power. Okay, so that's fairly low for us. I like to keep it around 50, but I've let my buying power slowly increase as some of these trades are coming off. Also, that's the benefit of trading some shorter term puts. I am a premium seller. 3 key strategies for me. I love selling naked puts. I don't care if they're on SPY in a PM account. I don't care if they're on the Qs in a PM account. I don't care if they're on ES, NQ, oil, futures. Doesn't matter. Naked puts to me is the way I like to trade. I love premium selling. I love getting paid. I love the safer out in time and out of the money contracts. Doesn't mean things can't go wrong. Certainly can. Okay, you can get assigned, but I'm okay. I have a loss that I'll take, or I can take assignment, or I can potentially roll. I have options out there, but I love premium selling. So I'm going to continue to sell naked puts pretty much everywhere we go. The strangle is one of my favorite trades. Okay, that's naked put and a naked call. So again, trading those naked options on either futures or other underlyings. I like the put credit spread as well. Okay, that is the defined risk trade, but it's a nice little trade. In fact, I just put one on today on copper. Okay, so we set up a copper put credit spread. We just had a winner come off in the other account as well. So I love put credit spreads. Okay, don't take a lot of buying power, great winning percentages on those. So those are good. And then the 112 trade is simply selling naked puts. We're also buying a put debit spread with some of the cash that we earn, but you don't have to do that. Okay, you don't have to trade the 112 and buy the put debit spreads. They rarely pay off and do anything for you. If you don't want to use it, don't. Take all the money. Okay. All I ask you to do is be aware of how many contracts you're taking on. And for me right now, we've shortened the DTEs, okay, so that we don't have them stacked and layered out there. And we're just being smart on everything that we've got. And if I think that the markets are getting a little overdone, we start selling naked calls. We turn these into a strangle. Or if we have a 112, we might turn that into a 1121, where we, a 2112, where we have two calls, two puts, and the put debit spread in the middle. The put debit spread is there primarily to give you extra gains if the market starts to sell off and has a sell-off. However, if you have enough enough put debit spreads stacked out there, it's going to give you buying power relief. It's going to help you in any kind of a volatility push. It's also going to help you with a delta hedge. So it's giving you a great amount of freedom and security to layer a bunch of those on. What you don't want is a ton of naked puts layered on if you're trading futures. If you're trading on a PM account, you don't want to overdo it either, because you may not be able to take assignment on these bigger contracts like SPY or the Qs. So you got to be smart. Anyway, bottom line for me today is, are you diversified? Well, you don't need to trade a bunch of stocks to be diversified. Okay, you can simply trade QQQ, SPY, IWM, and you can trade it by either selling naked puts and wheeling them. Okay, and I'm okay with the wheel on those. Okay, what I don't like is the wheel on crappy little stocks that don't have any quality to them, and they don't have a moat, and they don't have, they have a ton of debt, no cash flow, terrible stocks. Okay, hate the wheel on that stuff. Okay, you can watch my video on it. That's the whole purpose of that video. It's not that I hate the wheel itself. Okay, it's why I hate the wheel the way most people do it. The way I like to use it is sell the naked puts on high quality stuff, sell them out in time a little bit, give yourself some good premium. Okay, you don't have to watch them every single day. If you get a sign in a high quality stock, great, write covered calls on it. Okay, we could also sell some strangles, do some put credit spreads in the meantime, but it always ends up being a great recipe for us, or at least it has been for the last 30 years or so, and we'll continue to pile on these accounts. And over the long term, that's what we're looking for. In the trading account, we're going to have short-term hiccups. We took a short-term, hit this year. Okay, but we've been up almost 400% the last 5 years. Okay, we gave a tiny bit of that back. We've actually had enough to start other multiple accounts in there, and we keep funneling money into our investing accounts. Okay, one of them I share with you, the other one I don't. Okay, that one's growing and growing and growing. Okay, if you want to trade, make sure it's with money that you're okay with having some ups and downs. We're all going to do that. But over the long term, if we keep averaging 15, 20% or something like that, and we've had years where we were up 82%, like 2022, we were up over 30, 40% last year. We're going to be down 10 to 15% this year. Okay, we made a little bit of a mistake on some of the trades that we had on. Really, we just got unlucky on it. We weren't prepared enough. We were a little overextended. It's all good. We'll have it back. And next year, most likely we'll recover all of that and then some. So I'm looking forward to it. but stay there with the premium selling. Don't give up on it, but you want to be consistent. Consistency over time. Okay, you're going to take some hits. You're going to have some great years. What you want to do is over time, you want to keep compounding that money on average 15, 20%, okay, which is 1 to 2% a month. Okay. If you do that and you have the time frame, you're going to be in great shape. Everybody stay safe. Take care. I hope this was helpful to you. If you like this video, give me a thumbs up there. We'll see you tomorrow in trading. Take care. Bye-bye.